All right. Why don't we start off with your forecast for the average price for both WTI and Brent coming up in the new year? It's kind of pretty much where we're at right now. Why do you see things pretty much being flat on average?
So just to be clear, we have a $60 a barrel Brent forecast and $57 a barrel WTI forecast average for next year. And we think prices will likely be a little weaker in the first half of next year, and maybe things can improve into the second half. Now, remember, OPEC keeps adding production to the market to recover market share, and also we have a relatively steady demand backdrop. This means inventories will likely build, and there'll be some downward pressure on prices. Having said that, we don't see a crash for two reasons. First, because we think the Chinese will keep buying strategic inventories, will keep building strategic inventories, buying oil to replenish those, so all of the surplus will go there. And secondly, we think that OPEC has already shown their hand saying, we don't really want prices to crash. We are slowing down the pace of supply additions. We're going to be very careful how we add more oil going forward in order not to pressure prices much lower. So we think there's a little bit of downside pressure. We see a surplus, but we think the surplus can be accommodated for the most part in those Chinese strategic stocks without really crashing the market, if that makes sense.
Okay. I want to understand the equilibrium that you're looking at here, because your forecast is for GDP to increase by 3.3% next year globally, but only 1 million more barrels per day. Is that a normal dynamic with that kind of very strong GDP growth?
Well, I mean, I'd say GDP at 3.3 is not super strong. It's kind of similar to what we have this year. This year we're going to end up roughly around 3.4. Remember, there's a lot of talk about the recession a few months ago, particularly after Liberation Day. But GDP globally is going to be roughly holding up next year and be somewhat comparable to this year. Inflation will remain relatively sticky. We're looking for global inflation to stay around 2.4%, with the U.S. maybe ticking up a notch around 2.33%. And that's, I think, kind of normal from a demand standpoint. Yeah, I think we should look at our million barrels a day unless growth really surprises to the upside or to the downside, which are obviously risks to our forecast.
All right. One other commodity that's been very important to the markets this year, that's been gold. I want to talk to you about your outlook when it comes to gold, and also the fact that the trade war seems to be a big factor when it comes to the rise of gold, the Chinese central bank being a big buyer. We've seen the U.S. trade representatives say China's in compliance. We're seeing some friendlier trade situations going on. Does that change the tailwind from China's central bank buying in any way?
It could at the margin, but remember, China just reported a record trade surplus this year. So they're still accumulating a lot of foreign exchange, and they are devoting a chunk of that to the gold market. Part of it is obviously the large budgetary deficit situation that we have in the U.S. and also in Europe. And part of it is concerns around Fed independence and monetary policy. Where, of course, we know there's a number of very important decisions by the Supreme Court that will determine how much influence the executive, the Trump administration, can have on the Federal Reserve in terms of, how independent is the Fed going to be going forward, even if Kevin Hassett is the Fed nominee, which obviously has a certain power, but the question is really about the rest of the board. And then there's also the issue around Russian bonds. Remember, those have been frozen. The holdings of the Russian central bank have been frozen in Euroclear for quite some time. Those are the so-called funds stacked for Ukraine reconstruction. And within the 28-point plan discussed a couple of weeks ago, there is the potential of those bonds returning to Russia. So that could create more confidence in the system and maybe create a bit of a headwind for gold. But in reality, we remain bullish. We have $5,000 announced target because we think investors will keep buying gold in this fractured geopolitical environment with large government deficits.
Got it.
And what's likely going to be continued monetary easing, in our view.